The market is currently closed, but the last trading session for SoFi Technologies, ticker SoFi, concluded with the stock commanding a price of $29.72, marking a significant upward push of 4.32% on the day. While the headline numbers suggest a straightforward bullish close, the reality bubbling underneath the order book is far more complex and aggressive than a simple green day on the charts. Most retail investors are looking at this price action and attributing it solely to the broader fintech rally or perhaps a delayed reaction to recent earnings beats, assuming this is just another cyclical upswing for a volatility-prone stock. They are seeing the surface-level movement, the expectations, but the reality is that SoFi is currently undergoing a fundamental repricing event that institutional capital is quietly front-running before the retail crowd fully catches on. This isn't just about interest rate cuts or student loan refinancing anymore. What we're witnessing is the market beginning to assign a tech multiple to what it previously treated as a glorified traditional bank, and that shift in perception is creating a massive dislocation between price and value. The general belief, the common ground that most casual observers stand on, is that SoFi is essentially a digital version of a legacy bank, arguably a better designed competitor to Fidelity Investments or a slightly more mature cousin to the Robinhood app. The expectation is that its ceiling is capped by net interest margins and loan default risks, just like any regional bank. However, the contrarian take, and the one that forces us to rethink this entire valuation, is that SoFi is rapidly decoupling from the banking sector entirely in terms of operational leverage. When you analyze the latest volume spikes, specifically the institutional buying pressure seen in the final hour of Friday's session, it suggests that the smart money is no longer betting on SoFi's loan book, they are betting on the Galileo and Technisys integration finally reaching critical mass. This isn't a bank stock anymore. It is becoming the AWS of fintech, and the market is only just now waking up to the fact that the platform side of the business is about to eclipse the lending side in terms of margin contribution. Let's analyze the immediate price action we just saw. Closing at 29.72 puts the stock within striking distance of a psychological resistance level that has capped breakout attempts for months. The intraday volume was robust, significantly higher than the 30-day average, which indicates that this move wasn't just short covering, it was accumulation. When you look at the tape, you see a lack of significant selling pressure at the 29.50 mark, a level where traders usually take profits. The fact that the price held and pushed through to close near the highs of the session tells us that the sellers are exhausted. This is what we call a supply vacuum, where the liquid supply of shares available for sale at current prices is drying up, forcing buyers to bid up the price to find liquidity. This creates a powder keg dynamic for the opening bell of the next session. We need to discuss the macroeconomic pressures that are fueling this specific move. For the last 2 years, the narrative around SoFi has been dominated by the Federal Reserve's interest rate policy. The expectation was that high rates would crush their lending margins and that the student loan moratorium would permanently stunt their growth. Reality has proven completely the opposite. SoFi didn't just survive the high-rate environment, they utilized it to acquire high-quality depositors from legacy institutions that were too slow to raise their savings yields. Now, as we look at a shifting yield curve, the narrative flips again. A normalizing rate environment doesn't just lower their cost of capital, it reignites the refinancing engine that originally put SoFi on the map. But unlike the last cycle, they are now doing this with a massive sticky deposit base that rivals mid-sized regional banks, effectively lowering their funding costs to levels that competitors like Lending Club or even Ally Financial struggle to match. This brings us to the competitive landscape, which is where the real battle for your portfolio is happening. If you are sitting there using Schwab Intelligent Portfolios or navigating the Interactive Brokers Trading dashboard, you are interacting with legacy infrastructure. The user experience gap between SoFi and a traditional Fidelity brokerage account is closing, but in a way that favors SoFi's demographic. While Fidelity Wealth Management excels at servicing high-net-worth individuals with complex estate needs, SoFi has successfully gamified the transition from spender to investor for the mass affluent. This is a crucial distinction. Robinhood Markets captured the trader, SoFi is capturing the high-earning professional who wants investment help but doesn't want to pay a 1% AUM fee to a guy in a suit. By integrating SoFi Active Investing, SoFi Robo-Advisor, and banking into a single super app ecosystem, they have created a data loop that is incredibly difficult to replicate. Every time a user checks their checking account, they are nudged towards SoFi ETFs or SoFi stocks. This cross-selling efficiency is the holy grail that banks have chased for decades but failed to achieve because their systems were siloed. SoFi's tech stack was built from the ground up to do exactly this. Comment below how many shares of SoFi you currently hold and let me know if you are using their platform for your primary banking or just for trading. I'm curious to see how sticky their ecosystem actually is among active investors. Now we have to address the tech platform argument because this is the single most misunderstood aspect of the stock. When you buy Nvidia stock or Tesla stock, you are paying a premium for their dominance in their respective technologies, AI chips and EVs. When you buy a bank stock, you usually pay a low multiple of book value. SoFi is currently trapped in the middle. But the reality we discussed earlier is that Galileo, the payment processing platform they own, is effectively the plumbing for a huge chunk of the neobank industry. If you use a competing Fintech app, there is a good chance SoFi is making money on your transaction on the back end. The market has largely ignored this because the lending revenue overshadowed it. However, as the lending business stabilizes, the growth rate of the technology platform is becoming the primary driver of margin expansion. This is why we are seeing that price push towards $30. It's the market sniffing out a margin profile that looks more like a SaaS, software as a service company, and less like a bank. Let's look deeper into the institutional flows. Recent 13F fillings and the price action we are seeing suggest that major asset managers are increasing their exposure. We're not just talking about speculative hedge funds, we are seeing the likes of Vanguard and BlackRock adjusting their weightings. When these giants move, they don't day trade, they build positions over weeks and months. The steady climb we've seen recently, punctuated by days like Friday where the stock closes at the highs of the session, is a classic footprint of institutional accumulation. They are buying the dips, and more importantly, they are buying the breakouts. Compare this activity to Robinhood stock trading volumes, which are often driven by high-frequency retail sentiment. SoFi's recent volume profile looks far more disciplined, more structural. It suggests that the smart money believes the downside risk is now limited, while the upside potential of a full SaaS multiple re-rating offers a massive risk-reward asymmetry. However, we must remain objective and analyze the risks because blindly bullish analysis is dangerous. The expectation is that the regulatory environment will remain friendly or at least neutral. The reality is that as SoFi grows, it puts a target on its back. The big banks, JP Morgan, Bank of America, are not going to let a fintech upstart eat their lunch without a fight. We are already seeing traditional brokerages like Fidelity IRAs and Charles Schwab lower their fees and improve their digital interfaces to compete. If Interactive Brokers' fees drop or if SoFi Cash Management raises their APY significantly, SoFi's value proposition gets squeezed. Furthermore, the credit quality of their loan book is pristine right now. But if the macroeconomy takes a sudden nosedive and unemployment spikes among high earners, the white-collar recession scenario, SoFi's personal loan portfolio could see defaults rise faster than the market anticipates. This is the tension point. Can they grow their tech platform fast enough to offset a potential credit cycle hit? The price action at 29.72 suggests the market believes they can, but it is a razor-edge balance. Let's briefly touch on the business model for those who might be new to the ticker. SoFi, short for social finance, started as a student loan refinancing company. That was the wedge. They used that wedge to break into the financial lives of Henrys, high earners not rich yet. From there, they expanded into SoFi investing, credit cards, personal loans, and mortgages. But the masterstroke was acquiring a bank charter. This allowed them to hold their own loans on their balance sheet instead of being forced to sell them to Wall Street, drastically increasing their profitability per loan. Then they acquired Galileo and Technisys, turning them into a vertically integrated fintech infrastructure provider. They own the bank, they own the tech stack, and they own the customer interface. This vertical integration is what allows them to offer higher interest rates on savings and lower rates on loans than their competitors. They have cut out the middlemen. Looking forward, the outlook for SoFi hinges on execution. The future scenario that bulls are betting on is the financial super app dominance, where SoFi becomes one of the top 5 financial institutions in the country by market cap, powered by a massive low-cost deposit base and a high-margin tech platform. In this scenario, a price of $29.72 is laughably cheap. The bear scenario is that they remain a niche player, struggling to compete with the scale of Fidelity mutual funds or the gamification of Robinhood crypto, eventually getting acquired by a larger legacy bank for a modest premium. The catalyst to watch in the coming weeks is not just the next earnings report, but the guidance regarding the tech platform's contribution to total revenue. If that percentage ticks up even slightly, it confirms the thesis that